Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today for the third and final segment of our show. We're in the midst of talking about the what to do with your bond portion of the portfolio. If you missed the first part, head on over to our website, which is dlblain.com. There you'll find an archived copy of the show under the Knowledge Center, and you can kind of catch up. But I just started talking about what happened in the second quarter of the bond market. We saw bonds decline in value, and a lot of people started panicking. And I'm in the middle of going through some reasons why we don't think it's a good idea to just all up and get out of bonds completely and go into something else. And the number one reason is short-term moves in the financial market are rarely rewarded. Reacting to short-term news in the market is rarely rewarded. And yes, interest rates may go up in the long term, as I've said numerous times. Look at the history, look at the data, and rising interest rates. If your durations are reasonable, now if you have 30-year zero coupon bonds or something in your portfolio, yeah, you're going to see some major volatility. But if you have a duration or average maturity of your bond portfolio is somewhere around the U.S. aggregate index, which is around 5 years. Every 1% rise in rates equates to approximately a 5% decline in the value of those investments. But of course, the 1% rise in interest allows the coupon, now you're getting paid more income, such that over time it gradually catches back up. And so a large spike straight up in interest rates is certainly going to be painful and take a number of years to recoup that interest. We're acknowledging that. We understand that. But in a well-diversified portfolio consisting of different asset classes, bonds still have a main role. So don't make those decisions based on short-term. Make them on your goals and long-term characteristics of asset classes. The bond market overseas is actually larger than the U.S. market, and so we can study bond markets. Bonds have been around forever. There are bond and frankly stock market data going back literally centuries in some cases, and you can kind of get an idea of the characteristics of bonds just in the U.S. as well as overseas, and you'll see that there are very few time periods, if you have a reasonably short to intermediate term duration, where bonds actually lose a ton of money. But then the question becomes, okay, if not bonds, what are you going to do with your money? Cash, already said, unless you're going to spend it in the short term, cash is a losing proposition unless you need that money over the short term. So let's talk about stock market. Stocks have outperformed bonds significantly over the past year and dramatically since the depths of 2008, 2009. I have the numbers here that the S&P 500 year to date up about 20%, the bond market down about 2%. 1 year returns, the market up about 27% on the S&P 500, that Barclays aggregate down 1.5%. From 3/9/2009, which is acknowledged as the bottom of the bear market, to roughly the end of July, the S&P 500 is up 175%. The bond market is up 25%. Now, if you could rewind the clock back to 2009, we would say that it was a great time to be buying stocks. Stocks had just been decimated. People thought the world was going to collapse. That's when you want to be a buyer of stocks. So fast forward a little over 4 years from now, stocks have gone up 175%. And some other numbers on that. Do you realize, you may not, it's the fourth longest bull market in history that has not seen at least a 20% correction. I mean, that's just amazing. I mean, there's still people out there that are waiting for the markets to collapse. They have missed the fourth longest bull market in history. Because they're waiting for the U.S. economy to collapse. They're waiting for Europe to fall into the ocean. It's not going to happen. And then they've missed this huge market. Now, okay, so we missed that, but we're talking about bonds here. So do you really want to sell all your bonds and dump it into a bull market that's currently the fourth longest running. Now, we don't know. The market could continue to go up. It could correct today. It may be correcting today as I'm recording this show. We don't know. That's the point. We don't know. But in fact, if you had been investing in equities since the beginning of the bull market, let's say you had a 60-40 portfolio and you didn't do any rebalancing yet, equities would be pushing 66 to 70% of your portfolio, and you should be rebalancing. You should actually be buying bonds. I mean, that's the way it works. Is the asset class that goes up the most, you sell off and buy the asset class that has gone down. That adds 1% or 2% return over time to a well-diversified portfolio. We don't know what's going to happen to the equity market. We don't know what's going to happen to the bond market, tomorrow, and that's why we remain diversified. In fact, paradoxically, the decline in the bonds the past quarter, or in the second quarter, raised their expected return. So you went from about a 1.4% yield on the 10-year Treasury bond. That means your expected return over 10 years for 10-year Treasuries a couple of months ago was 1.4%. Today, those same 10-year bonds are yielding about 2.6%. So the value went down, but the expected return for the next 10 years just went up. And so when the price goes down in bonds, you buy because the expected return is higher. So some other numbers, the S&P 500, the PE multiple is 17.4. It's about roughly 10% above the median, so not tremendously overvalued, but some cautious. It is in the 70th percentile of historical performance. So we don't know that there's going to be a bear market around the corner in stocks or bonds at all. And so we think that the fixed income bubble that people are predicting is somewhat overdone, and we still think that high quality bonds are very important to diversification. In Japan, they've had very low interest rates, below 0.5% for about 20 years now. Just keep that in the back of your mind, that it is not a foregone conclusion that interest rates are going to all of a sudden pop back, to 6-7%. All right, well, that's about all the time we have for today's show. I hope that was some use for you. Just think through your bond position and focus on the long term and not the short term movements of the market. Okay, well, I'm your host, David Blain. We'll hope to see you again next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.